Let's just start simply with your general reaction on the proposal, a 10% one-year cap on credit card interest, please.
Yeah, well, look, I think the president is right. You know, the Americans are being ripped off. I mean, $160 billion in interest charges last year, 31 billion in fees. That is not a financial services industry. It's an extraction machine. So, and we've seen in Europe that putting interchange regulation and interest rate caps in place work really well.
Right. Sebastian, Klarna has a credit card. That credit card has an APR of 29%. Outside of the purchases that are made in pay for plans or buy now, pay later plans. So you do have a credit card that is at the levels the president's talking about, right? Are you going to reduce the APR, therefore, based on what the president has directed or proposed?
Absolutely. And the thing is, obviously, we need to follow regulation as everyone else. But the truth is, if you look at Klarna's business model, those rates are very uncommon. And the majority of our business is built around the buy now, pay later model, which actually charges only merchant fees and offers interest-free credit for consumers. And that is in huge demand in the US. I mean, I think it's quite interesting. If you look at Fed's own data, it shows that credit card rewards redistribute $15 billion annually from the poor to the wealthy. And that high FICO consumers gain $200 a year, subprime consumers lose $55. That isn't financial product. It's a regressive tax with airline miles, right? So I think that this is something that's starting to become apparent in the US, and I think that all regulation that makes it for better competition but more fairer competition is good.
Why have that credit card at all with that sort of level of interest rate then, Sebastian, if most people are using your other offerings?
Well, that's exactly the challenge for us, right? We're competing with an industry that basically by charging so high interest rates is offering very attractive reward systems and so forth. And so we obviously need to adopt to the market, and we're adopting offerings to that market as well. But what we have seen is that we also have a debit card that offers premium benefits. And so we have a plethora of products, and the majority of our products are interest-free and much more favorable with the customer, more appreciated by the customer. Sorry.
What's interesting is you reference the Fed's own data. When you're looking at some of the other areas of data, I'm looking at the World Bank, Fed Bank of Illinois. There's academics in Oregon or Arkansas who've looked into if you cut down interest rate levels, the argument goes you cut off access to finance writ large, you get loan sharks doing better. Sebastian, how much do you think people would turn instead to buy now, pay later if they can't have that sort of credit card availability if it was shut down because they didn't have 30% levels anymore?
Well, the thing is, right, if you look at our average outstanding balance for us, it's about $100, while on a credit card it's $5,300. And the whole credit card was constructed in a way that it's trying to get you to revolve every month. That's what all of your spending is on credit. And then it's trying to get you to revolve at that 30% interest. We don't offer revolving. We do installment-based because it's safer and better for the consumer. So the point is that if you have a whole industry built on the idea of maximizing out debt, that's also where the majority of that revenue flows from. And what we've proven is that if you offer credit that is more affordable, that's better for the consumer, losses are actually significantly lower as well. Our charge-off rate is 0.4%. Banks are 4.2%. So there's obviously their devastation is maybe they're worried about isn't for the consumers. They need those high interest rates to be able to lend that kind of money if they're having those kind of losses. So our experience is that no, if you're willing to be an affordable lender, there is a huge market opportunity there, and consumers show appreciation for that model. So that doesn't have to lend, it doesn't have to mean that you can't offer credit to everyone. But at some point in time, when you start moving above the 30% interest, question is, should anyone borrow at that rate? And I'm not sure the answer is yes.
Sebastian, who are you speaking to within the Trump administration, if anyone at all? Who do you hope to speak to understand the plan from this point, from the administration's perspective?
Well, we're as curious as everyone else on how the implementation of this is going to do, due to, generally speaking, those caps have been implemented on state level in the US, right? So we're waiting eagerly to find out how exactly this is going to go about. But again, I think that our experience from Europe is that interchange regulation as well as inter-raised caps are actually quite effective way and feels like a fairer way for the American population.
Paige Smith, who covers you guys, our colleague in the newsroom, made a really interesting point yesterday, which is how many people actually know what the APR on their credit card is. Could you reflect on any data that's crossed your desk this morning, on inquiries that you've had? Like, has the reaction from the consumer to this been, I had no idea I was paying 30% on a credit card?
Well, I think that's the whole construct of the product, right? I mean, they're attracting you with high rewards, they're attracting you with low interest rate, and then it changes over time. The point is, in the US, there was a McKinsey study in 2015. It identified a group of Americans called the self-aware avoiders that are about 20% of the population. Those are people that have been tricked by the credit cards. They found themselves in more debt than they wanted, but they paid it back. Their annual household income is 20% higher than the low-income households, actually. And this is the group that's using Klarna primarily. This is a group that is, again, self-aware avoiders. I'm sorry to recommend something else, but I would actually go to Netflix and watch Credit Cards Explained, and you see all the tricks that banks have applied to trick people to borrow more than they need to.
Sebastian, briefly, your global perspective, where in Europe have they put caps on, and how has it worked, briefly?
So it's different across different jurisdictions, but basically Germany has among the lowest cap. France has caps. So the German cap, if I remember correctly, is around 14-15%. In France, it's close to 18-19%. So those are caps that are quite effective. There's also other things that people do. It's real-time pooling of loan to kind of look at your total exposure to all banks. So there's a number of, I would argue, pretty effective ways to help people avoid the most negative type of borrowing.